Hey there, Daniel Mersky with Mountain Properties of the Carolinas, and we are your resource for looking for short-term rentals in the western North Carolina mountains and upstate South Carolina. And we have a special guest today. This is Matt Harbour with Howard Hanna Mortgage. So Matt, if you want to just kind of introduce yourself, tell us a little bit about your background.
Hey guys, Matt Harbour, Howard Hanna Mortgage. I have spent a good deal of my career in mortgage and finance, almost going on 20 years. So I've been doing this a while and happy to be sitting with Daniel today and sharing some information with you guys.
Great, well thanks for being here. So a couple questions here. How is financing really different when you're looking at a short-term or an investment property turning into a short-term rental? How is financing for that going to be different than if you're looking for a primary residence?
Yeah, so great question, and it's usually the one that we get to with people doing this the first time. Differing from your primary residence, where there's a lot more options as far as down payment and loan to value goes, on an investment property, really conventional wise, you're going to be looking at least 15% down, and that's so it's going to be a little bit more expensive. Essentially, your rate's going to be a little bit higher, and you're going to be looking at about 15% down.
Okay.
Yeah.
Now, as far as loan types go, I know you mentioned conventional. Are they still offering conventional, USDA, VA? Are all those still offered for investment properties?
So investment kind of takes a couple of those off the table. So FHA, VA, USDA, those are geared toward your primary residence. Conventional is really going to be the meat and potatoes of investment property financing. And those are largely underwritten by Fannie Mae and Freddie Mac, so they subscribe to those guidelines. So really, there are some one-off situations where an FHA or a VA may have some place there, but usually that's a situation where you're occupying one portion of the property and then possibly renting out a different portion. Which obviously is probably not going to be the case for a short-term rental.
Gotcha. Okay. Now you had mentioned you might see a little bit higher rates for investment property. Talk to us a little bit about that. How much are we looking at there, and are there other kinds of increased fees or points that we might be looking at? For that loan?
So that's can kind of be the rub with investment properties, and maybe a hurdle to get over. For those that are doing this the first time. Primary residence obviously does not have a lot of the loan level pricing adjustments that investment properties, second homes do. But that plays into the points. So points and the rate go really hand in hand there. As far as fees go, there's not really any hidden fees or extra fees other than the single property comparable rent schedule. That we usually do on an appraisal for a rental property. But there again, your interest rate is going to be a little bit higher. Generally speaking, somewhere in the half a point to 3/4 of a point higher than your primary residence.
Okay. And I know that you said down payment you're looking at maybe like 15% at least, maybe 20%, correct? Was that correct?
Yeah, so 15% really is going to be the minimum that's required for an investment property. And there is a distinction between investment property and second home too. So the way that Fannie Mae and Freddie Mac take a look at that is if you are planning on occupying the property for any portion of the year, that can be financed as a second home. There's not a lot of differences between second home and investment properties as far as the way that they finance. On the investment property, sticking with that, you will need at least 15% down. On a second home, you need at least 10% down. Other than that, the loan level pricing adjustments, the points therein, and the pricing really do mirror one another on both second and investment properties.
Okay. Well, just a couple more questions and we'll start to wrap up. But when applying for these types of loans for investment property, what kind of credit score do lenders look at to approve?
Yeah, so if you're new to this and if you don't have 6 investment properties already in your portfolio, The Fannie Mae and Freddie Mac guidelines really are the overriding guidelines. So really they're looking for a minimum credit score of 620 and debt to income ratios at 45% or less. North of 7 properties, 7 or more, you're going to need at least a 720 credit score. That said, in an ideal situation from a pricing perspective, 40% down and a 780 credit score is going to get you the best possible rates and pricing.
Gotcha. And now let's say you are someone that's already has a few investment properties, really income producing properties. Are you able to use that as part of your income when getting a loan, and what does that look like?
Yeah, absolutely. So absolutely take into account current rental income, whether that's from another property. There are certain circumstances that we can also take a look at anticipated income on a rental property as well and factor that into debt to income ratios. Generally speaking, underwriters, when they're taking a look at rental income, they're going to use 75% of whatever that income is going to be. So for instance, if you've got a property that's renting for $1,000 a month, you can plan on us using $750 of that for your income for that property.
Gotcha. Yeah. All right. Well, that about wraps up all the questions that we have. So thanks, Matt, for joining us today. It's Matt Harbour with Howard Hanna Mortgage. And we're going to put his contact information below, so if you're starting to look into that process, reach out to Matt or reach out to us with any other questions that you have, and we can contact Matt as well. But we're going to have more videos coming up ahead, so be sure to like and subscribe. Stick with us for what's coming in, and we'll see you next time.